is Marin Katusa. He runs the KCR fund, which is one of the most significant resource-focused funds in Canada. He also runs Katusa Research, which is one of the leading research firms in Canada as well on the resource space. And Marin is also a huge supporter of Palisade and the various things that we do, so please give him a warm welcome. Marin, welcome to the stage.
All right. This is a special conference for me because usually I'm on the road alone. This time I get to bring my wife and our third child, so it's been quite the pleasure. So just a bit about me. So I've been in the resource game for well over 15 years, and I'm going to take a very different perspective here. I don't believe there's any shortages of metals. I don't base my things on population growth. I'm going to base it down on really the nuts and bolts. This was an interesting one because I ran into Phil at in Chicago, and it kind of reminded me of over 15 years ago, and yet some things really don't change, but at the same time, rather than hustling and working hard, I had one child in my hand, and a 3-hour delay kind of felt like the resource sector always being delayed. So this book I wrote in 2014, it was kind of my first big project after my heart surgery, and it's a New York Times bestseller. Colin, I noticed you didn't give one out to everyone here. Maybe next time? Attaboy. So anyways, I really don't care if you buy it or not. This was more of a passion project that I did. I never expected it to be a bestseller, it turned out. So Boom, Bust, and Echo is actually the topic of my second book. So when you have a book deal, they lock you up for your second book, and they really wanted me to do a revised version of my first book because it was their #1 seller for Wiley and Sons. I wanted to go a different route. I wanted to break this thesis that I had about what's going on in the resource sector. I've raised well over $1 billion, probably over $2 billion now Canadian for these resource deals. And let's get into what I think is happening here. So governments fear deflation more than anything else. I love this line. I don't know who created it, but gold is the currency of kings, silver is the currency of gentlemen, barter is the currency of peasants, and debt is the currency of slaves. And basic conclusion of this is, ironically, I think in the near term, the US dollar is going to be the victor of all this, meaning a strong US dollar. Silver, there's fewer gentlemen in the world, so I think silver is going to have a tough go over the next little while. And I think gold will be the surpriser. So where are we really at with the sector exploration budgets? People keep saying we're not spending enough to find these deposits. It's actually not bad if you look at historical measures. So here's the question. Are the geologists worse, or are the projects harder to find? How about the answer is a bit of both? When you look at a David Lowell, we talk about Pareto's Law, one man who kind of created the whole porphyry model, or Roman Schlenker, the game has changed, and also the brightest minds didn't go into geology during the 80s and 90s because there was no work in the sector. When you compete with the tech sector, or in Canada in the residential sector, finance sector, we're not getting the best minds. So I think the answer is a bit of both. Projects are getting harder to find, but I think a lot more money is going into non-direct exploration. Think about G&A, think about legal. You look at the cost of a social license. First of all, who issues a social license and what is a social license? And you find out that it's an infinite answer, meaning you'll never get it. So much less is actually going into the ground from the money we raise. Hence, you're getting way fewer actual world-class global discoveries. So we're looking at, what do we got here? Gold discovered in million ounces, and I'm only focusing on Tier 2, which is defined as 3 million ounces, or Tier 1, 5 million ounces, so above 2 million ounce deposits. And you look at the exploration budgets are going higher, but we're finding less. So the argument about having less money in the sector is not true. So it's no doubt we're not finding any more pebbles, okay? And even if you do find it, you got to fight the NGOs who are funding it. So 2 weeks ago, I was invited to talk at a conference, which I found really interesting. You had Kyle Bass there and all these kind of Peter Thiel and all these super wealthy fund guys. And the son of the main funder of Pebble came up to me and shook my hand, and I was kind of surprised that, you know, he's now a supporter of Pebble, yet his dad put tens of millions of dollars to fight Pebble. So you find out that even if there's an NGO, what is their agenda, and something the North American markets should find, if there's any reporters watching this or regulators, something that Putin and the Russians are doing, which is right, that I talked about in my book, is if you're a listed NGO, you have to define where are you getting your funds from. Therefore, if you're getting, like, against, for example, Tazico with their projects in BC, or Pebble, the market, the society, the community will understand where's this money coming from. And in Canada, with our pipelines, you end up finding out that it's being funded by American interests. So these are interesting things. The Reserve Life Index, the RLI, of major gold producers, basically you take your gold reserves divided by your annual gold production. It's down significant. Now, this is something that we use in the oil patch. RLIs are a big metric. You see that it's kind of going down to about 15 years, but it's not that serious. The majors aren't freaking out yet. If you look at some of the major oil producers, when M&A truly happened, it was when they touched the 9-year RLI index. So I actually don't see this as a major catalyst of gold guys continuing to emerge. That's not the thing. What is alarming is the average grade per ounce produced is down significantly from, you know, just over a decade ago, just under 2 grams per ton produced, to now about 1.37 grams per ton. That's a big, big difference. So you're mining a third lower grades, so obviously your costs are going to be higher. So your gold production versus your reserve grade, which is interesting. This is on primary gold production, and if you look where we've gone from, you know, the grades going lower, your costs, but what is interesting is if you look at your byproduct of gold production, from your porphyries and all that, today, or last year, 2018, the gold producers' global annual productions increased by 1/3 from the year before the GFC. So think about that, right? So with all of the money that went into the sector, the world is producing more gold than it is with the byproducts. This is primary gold production. So exploration cost per ounce discovered. This is getting expensive now, where primary gold producers are paying up to over $200 per ounce discovered. That's where they're going to start taking out these juniors, where if your market cap is $40 or $50 million market cap, do you really, truly, honestly stand up in front of an audience and think you're going to build a capex of $2 billion? Please have more respect for your audience. It ain't going to happen, right? So where you can do is what Pebble did. You can bring in a bunch of financiers, replace the board, and then you bring in partners who will develop it. And, you know, it's very rare that a junior with a 40 million market cap is going to develop a $2 billion asset. And I've been involved in mines that have been built for 650 million, where I was one of the founders on Copper Mountain, and you have to have a major partner like a Mitsubishi or a major. So how has the industry done as a collective interest? What I decided to do here was take the market cap in 2004, take all of the financings that the sector's done, and you deduct how it's done, and you find that the true net growth in the market caps is down 3 billion. It's been an absolute waste of time. So Matt, who was up earlier, said never buy the basket. It's a horrible place to be. Yet if you're very focused, if you're a sniper, you'll do quite well. So where's the cash position right now? There's still a lot of money in the venture. If you look at the cumulative cash position of the mining sector just on the venture exchange, it's over $2 billion at the end of last year. But on a company perspective, people keep asking, why are so many of these zombies still alive? They're savvy cats. They're able to figure it out. Yet last year, the average median cash position was just over 400 grand of a company that has exploration or mining or some form of, you know, hope of doing things. 400 grand, the only thing you can do with 400 grand is pay the CEO's salary, his parking spot, and the rent for their office. You as an investor will have absolutely nothing. You'll have no catalyst, so that's kind of key. So now let's do a filter. How many of the venture mining companies have cash above $5 million? As of last year, there's 92. So out of the 2,000 and something listed, you can just do a quick filter of 92. Now, yes, granted, you might miss that 2-cent stock that might be able to do something. But it's very rare you'll be able to do that. So if you do a quick filter, you find out that, maybe it's the good guys with the good stocks with an actual idea and a real registry of shareholders that will do something. So we look at and I'm focusing on the venture because whether you're an American or an Australian, the TSXV really is the mining capital hub of the world. If you look at from Lundin to Friedland, it's where all of the big discoveries started. And it's just how it's been historically. It was the Vancouver Stock Exchange and the Alberta Stock Exchange. They merged and that became the TSXV. So if we take the market cap versus the equity raised, we see that, we're not really running out of money. This fallacy that there's just not enough money, it's there. And this is during a time of Bitcoin and cannabis, which has really been a detractor to the resource sector. So here's something that I sent one of my former students who's worked for me for over 13 years, taught him calculus, really, really smart kid named Mike Chang. I said, hey, okay, go to all of the historical public company reports. We went to the microfiche, we went into the old data files, and we went back to 1900 from Homestake and all of the miners. And we said, what is the actual yield of mining companies? Because you've always heard that saying, wow, that's a gold mine. But then for years, I've been told from the investment community, Marin, we don't invest in gold companies for yield. We invest for leverage to gold. That kind of sounds to me like a promoter who came up with an excuse for the reason we don't invest in it, right? So historically, you find that the gold producers and actually the base metal producers were in the highest quartile of dividend producers historically in the stock market. It changed right about when gold took off in the late 70s, so I'll get into that in a bit. One thing I should have put on this chart that was wild to me, I initially assumed, being Canadian and being of our generation of low interest rates, that the reason why the average gold company in the past paid such a high interest rate was the Fed rate was really high, right? That was kind of what you would normally think, oh yeah, but the Fed rate was probably 8%. What's interesting, in the 50s to 60s, there was over a decade of just above 2% interest rate that nobody talks about. And I was like, wow. So you could make 3 to 4 times more than the Fed rate paying buying gold stocks, whereas today a gold company is paying a lower rate than the Fed's paying. So what has happened during this time? So I really want to get into what happened. Well, once gold started kicking into these high salaries, mergers and acquisitions started happening. You look at, for example, Placer Dome in the 90s, which was Canada's Teck Resources before. But it was Placer that was the real wealth generator. Dome was a gold company that traded at a higher valuation because of the 1978 when gold started rocking all the way to 1980s, early 80s. And it went and merged with Placer. So if you look at Cortez and all these assets that really built up Barrick and some of the Goldcorp assets, that came from Placer. The big porphyry models that David Lowell discovered and David Lowell discovered them, Placer developed them, and Roman Schlenko, who works in our office he's the guy that does a lot of my geology, he was the VPX for Placer. And when they merged with Placer Dome, then they got taken out. Accountants started taking over the industry. Investment bankers and these engineers who built these got pushed out and were focused at the mine. From 1900 to basically 1982, the executives of these publicly traded companies made 3 to 5 times more than the average mine manager at the mine. Then it kicked in where now the average executive makes anywhere between 30 to 50 times the average salary of the mine manager. So think about that massive change that nobody's talking about. So what happened really when things started kicking in? Look at the debt, and this is in the global mining and metal sector, so gold, copper, iron ore, you name it. And you look at 2009, these accountants dipped into cheap money worse than other sectors. For some reason, people in the gold sector think that we're disciplined and gold is real money. Probably is, but the CFOs who are running these things went to the trough in a big way. We are just entering the wall of worry. You look at that number at 220. That is a lot of debt for a small industry. So, a lot of this, for example, and I wrote a whole article about this, if you look at Teck Resources, before 2009, Their 2006 bond traded, they did a $500 million bond, and it was at 5.6% interest. They did one in 2012, so the market started doing well. It was 5.2% for a 30-year bond. In 2016, they had to pay 8.5%. Let's think about this. Teck is Canada's largest diversified miner, and they had to go from basically 5 points to 8.5, so over 2/3 more cost of capital in just 4 years, and they had to do it on an 8-year loan because they couldn't get a 30-year loan. So if Teck, which has some of the best met coal deposits in the world and some great coal projects, and they have one of the world's best, they own 25% of one of the best heavy oil projects in the oil sands with Suncor, if their cost of capital was 8.5 points, what do you think a junior's cost of capital will be? The true cost of capital. This wall of worry has to be refinanced. Okay? There's hundreds of billions of dollars every year for the next 5 years. The cost of capital is getting higher. Then I wrote this article that got me a lot of hate mail, and that's when I know I'm doing something right. If you agree with me, you're probably thinking I'm intelligent. If you're thinking, wow, this guy's arrogant, that means I'm doing something right because you disagree with me. And I'm just talking facts. This isn't opinion. This isn't what I want to believe. This is what I'm seeing on the balance sheets. When Warren Buffett went to Oxy, and I know one of the board members quite well of Oxy, got 8.5% warrant on the 5th largest producer of oil in America, which is Oxy, when they took over Anadarko. If they had to pay 8% in this wall of worry, which I'll show you the next picture, here's, this was the, you know what, I didn't put the oil and gas one. The oil and gas sector is even better disciplined actually than the mining sector. You'll see in the next wall of worry, it's still big, but not as big as the mining, but the revenue in the oil and gas sector is big. That's the new norm in this high wall of worry interest rates. So if the big boys are paying 8 points, expect the cost of capital for the juniors to be well into the 10 to 14% if you're a mid-tier, higher if you're lower. So what is this boom bust echo concept that I had? After doing this for 15, 16 years, you get this massive boom, you get the bust, and then because of 2008, we didn't get an echo. So I went back to over 100 years of data, and I realized that this was an anomaly, this kind of quick inflection point of the GFC because of the financial heroin of QE 1, 2, and 3. But then we got another bust, and now we're in the echo, which is the historical norm. And an echo, unfortunately, can go for up to 16 years historically. So there's a great book written by Norm Keevil, Jr. I don't know if you guys know who him. His father really is the guy that started Teck. It's Canada's largest diversified miner. Russ Halbauer, who was a competitor and became a good friend of mine, he's the president and CEO of Taseko. They're the second largest producer of copper in Canada. Copper Mountain's the third. I'm one of the founders of Copper Mountain. So for like 10 years, they hated me because I was running around the world saying why we were going to build this. Nobody ever thought we were going to be able to finance it. We got it done. And then when I had to remove Russ Halbauer from the board of Northern Dynasty, he got a little agitated with me, but it all worked out well, so then we became friends. His dad, Bob Halbauer, was one of the legends who built these mines, that built Teck. And after getting to know Russ really well, I started asking him, why did your dad able to build so many mines? And Russ, you haven't, right? I was being a little cheeky. And it came down to the environment, cost inflation, the social aspect, and it's the environment has turned completely different. And yet I think we're going to be in an echo for longer. So how do you make money in the echo? It's not just our sector that is in an echo. If you look at every industry, it has the echo. So Altera Power, Ross Beatty became a very close friend of mine, but initially he saw me as a very arrogant and abrasive young guy because at the 2009 conference, Obama came into power. It was at a Casey conference that I was moderating, and it was the green energy revolution. We had Rick Rule on stage, Ross, and Rick was just ecstatic about Ram Power at the time, and Ross was talking about Altera, And it was 25 bucks a share at the time, and you let them do their thing. I'm just the moderator, and someone in the audience, this is videotaped, you can YouTube this, goes, well, Marin, you're the mathematician, what do you think about this? And I go, they're priced to perfection. You're even seeing how Rick's talking about how the environmentalists like them. And I go, I don't know when, but I think these things, all these geothermals will go down 50 to 75%. And then you let them develop their assets because they're financed now. But even if they built what they say they're going to build, they're priced like they're going to be producing exactly on time. And one thing you learn about all these projects is a mine never comes on perfectly. You're going to have things that go wrong. And it went from $25 to $3, Altera. And that's Ross Beatty is the chairman, and he owned 1/3 of the company. So if you think that a Robert Friedland stock can't go down 75%, you shouldn't be in this industry. So that's Ross's deal, and I ended up buying 10% of it, talked about it, and it was in an echo phase for about 3 years. And yet, the company that bought it out just sold their Iceland assets for the price that they bought the company for. So these are very cyclical stocks. Another great example is Reservoir Mineral. I'll tell you a story about Reservoir that very, very few people know. Miles Thompson, the founder, is a very close friend of mine. He was at our wedding. And he vacations at my place in Europe. And I remember in 2008, we were talking about what to do. And then 2009, this is both at my place in Europe. And he goes, well, our board just decided, Marin, we have to sell all of our mining assets in Serbia. We're going to be a green energy company in the Balkans. And I go, oh my God, I'm Balkan. I understand the Balkan mentality. I got citizenship there. And I go, let's buy this ourselves. And it was a tough time. We tried to figure out how to finance it. So Miles and I went to the Lundins. And you could have owned 100% of the Reservoir portfolio for $1 million. So that's what we did. And initially, they were going to do a joint venture with Antofagasta. It turned out to be with Freeport. And that became taken over by Nevsun. And you look at how the stock went up and down. These are ultimate stories. And then it got bought out by the Chinese. That's the Timok deposit. So for $1 million, it went to over $1 billion. And that's the example there. And now Copper Mountain Mining is one I took so much heat. And I think Phil and Dave in the past, they saw me doing this in real time. And I got in trouble when I went on BNN, and I didn't know you weren't allowed to talk about what you're doing with your own capital. And as a director, I said, look, it's 40 cents right now. I am buying hand over fist. I'm the largest individual shareholder, and this is how you make 10 times your money. And I said that on TV. I didn't realize you weren't allowed to do that because that's what I truly believed. The chairman, Jimmy, also bought a few $1 million worth of paper in the market. Within 20 months, it went 22 times your money. We built the mine. It went from a 40 million market cap to $1 billion, but it's how we financed it. We brought in the Mitsubishi with an offtake agreement directly at 4% money. And then the realities of the copper market. When it was $8 a share, copper was $4. When it went to $2, we went to 50 cents. And again, we did another financing there and went to $1. The company will stay alive, but this is the boom, bust, and echo concept. Now, Teck Resources is the ultimate example of this. If the largest producer, diversified miner in the country, went up 10 times, crashed 95%, went up over 10 times again, went down again 90%, and then you went up 680%. This is all in 20 years. If you just played this one stock, you'd be one of the best money managers in the industry. And then here's the one that I'm in the markets most known for is the Northern Dynasty story. 25 cents to $20 a share. Went down to 40 cents a share. I put 43 million into it, restructured the board, went to $4. And then we had the massive short report. Now, one of the guys earlier talked about shorting. The interesting thing was there were no shorts before the financial crisis in mining. If you look at, for example, Voisey Bay, he never had a short report on the stock. He never had a short attack. So this is a new innovation that the mining sector, which is really based on a hope. You get a geologist with a box of crayons who colors a bunch of pictures and says, look, this is what I believe's here. Give me a bunch of money to drill this out, prove it out, and then hopefully the people want me to build it up. And then after I invest a couple of $1 billion in, let's hope the government doesn't change the rules on this. So the angle here is that it's such a belief story in hopium, and the cost of that hope is so easily shortable. And that's where every story now, even if it's a success, it will be shorted, okay? So here's an example of, was it better to play Northern Dynasty or Teck Resources? It depends at what time frame. Here's when we did the big financing on Northern Dynasty. You would say, well, Northern Dynasty is it was a much bigger performer. That's if your window was at the end of, that was about April 2017. But if you go to January of 2016 to the April of 2017, you see that Teck was a much lower risk. Yes, you would have made more money with Northern Dynasty, but Teck Resources would have been a better investment. So as a fund manager, I always critique my own investments, and I go through it as a stress test, and I said, you know what? For all that work I did on Northern Dynasty and restructured the board and put $43 million in the market at the time when, granted I got a full 5-year warrant that we listed, and I wouldn't be able to do that on Teck, but I wouldn't have had to spend 8 months on Teck. And the liquidity on Teck would have been a better investment, right? So ask yourself, what is your risk and your time commitment? So I'm going to talk about one that I think is in the echo right now. This is the price of uranium since 1970. And you look at that massive boom, bust, echo, boom, bust. And I think the echo is going to be for a few more years. And the uranium market hates it because uranium speculators are like gold bugs on steroids. They're worse than silver bugs, okay? So I would actually say uranium speculator is a silver speculator on steroids. So where is it really at? In 2017, about 130 million pounds, but that red is Russian influenced. What's wild about America was, in 1980, America produced about 40 million pounds of uranium. For 2019, it's projected to produce less than 1 million pounds. And Phil, I don't know if you were on the site visit in 2004 when we went to Kazakhstan, or 5, they didn't even produce 1 million pounds that year. And within not even 14 years, they went from 1 million pounds to 65 million pounds using American technology. So it went from 40 to 1 for the Americans, and from 1 to 65 for the Kazakhs, and all roads lead to Russia. So when it comes to enrichment capacity, the Russians do have a stranglehold on Kazakh production. The leader of Kazakhstan has planned his retirement. I wonder if there will be a power vacuum or will it continue? He's been a leader since the Soviet times, and his children aren't taking it over. So you look at the global demand, where is it? Well, America is still the world's largest consumer. They use 55 million pounds a year. It ain't going away. But people say, well, what about Japan with their nuclear reactor shut down, and Germany? So what I did was, knowing that the shorters are going to short anything that goes up in the resource sector, I wrote a short report for the short report guys. And it's wild because people don't read these reports. There's all this misinformation that I was shorting the uranium sector, which is mind-boggling to me. I'm one of the largest financiers in this sector. So I said, okay, if you actually look at the cumulative demand lost for the actual planned nuclear reactors that are going to shut down, what % of demand in a worst case scenario? So let's do the homework for the short report guys. By 2040, the worst case scenario is about 55% demand lost, okay? Every year it's about 180 million pounds right now of uranium consumed. And then someone said, well, you can just replace it with thorium. Well, you can't. You can't just put thorium in a nuclear reactor. And second of all, does anyone know what a nuclear reactor fueled by uranium produces that a thorium reactor can't? Anybody? Plutonium, which is it's a byproduct, and what do you use that for? A bomb. So the military complex would rather have that than not, because if you're the Americans, you already have this giant uranium-fueled nuclear sector. You can't just switch it like a coal facility that you can switch to gas depending on the price. You can't do that with nuclear. Do you think the Chinese are going to say, yeah, we'll do a thorium reactor so the Americans get to keep building bombs and we're not going to have that? Of course not, right? So like, I've been to all of the producing uranium mines globally. I kind of get a good idea of who's who in the zoo. And the reality here is there's something coming up called Section 232. And this is where I really get a lot of hate in the sector. I don't think it's going to be what a lot of people think. If you YouTube the interview I moderated at my conference with Jay, the VRIC, the guy who was the main petitioner of Section 232, Jeff Klenda, that was at one of those pictures. I was with him on site in 2014, and he's a big fan of my book, and he based the Section 232 off of my uranium chapter. But what he got wrong was, I think it's going to be a quota system that starts with about 5% of domestic demand the first year. This is just for the US. So I said that, you know how oil trades and, you know, there's a Saudi price, there's a Canadian price, there's a WTI for American price, but uranium is fixed. There's a long-term and short-term price. I think we're going to get an American price and a Russian price. And what I see the result of Section 232 being, then you'll see a 10% domestic demand the second year, then probably 25%. So if you do the numbers on this, I think the quota system will come anywhere between 50 to 75 pounds. But you don't need African uranium to do this. You actually don't need Canadian uranium to do this. So what you want to do is stick to unobligated, mean unhedged, permitted, and built US production. Everything's so cheap right now, you don't need to take any risks. You don't need to take drill bit risk. It's cheap. So that's what I see happening in Section 232. So I'm going to talk about some trends I see in the next 5 years. In my book, I had a whole chapter on the petrodollar, something I found fascinating and studied. I actually think we're going to have the unwind of the petrodollar over the next few years, and we're already seeing it. There's already proof. In 2013, there was, for 100 years, there was an act about how Americans had restrictions on exporting oil. Well, now that they are exporting oil, at the end of this year, there's a new pipeline being built in the Permian that's going to release another 500,000 barrels a day for exports. Think about America, which used to import $200 billion of oil a year at current prices, even a decade ago. That $200 billion would go to the Middle East and Venezuela and Canada. Now they're exporting $100 billion. You're looking at a $300 billion net change in the petrodollar shift. That is massive. So there's fewer US dollars in the world. Then you're looking at this massive wall of worry of debt, which is in US dollars. There's going to be a shortage of US dollars in the international market. And saying that at a resource conference or in the sector, it's kind of like I'm the pariah of the industry. So that's where most people disagree with my argument. They believe that because they believe in gold, that the US dollar has to go lower. I don't see that for the next 12 to 24 months. I think the US dollar is going to outperform almost every currency. And this has huge, huge impacts on the commodity sector. For example, let's talk about uranium. The country I was talking about, Kazakhstan, the Kazatomprom, which is the world's largest primary producer, about 40% of the world's production, how could they not decrease when the price of uranium went $50 to $25 like Cameco? Cameco shut down McClean Lake, which is one of the biggest and best, highest grade uranium mines on the planet, because the tenge depreciated even more than the price of uranium. So their cost, their mines are already built. So they could just keep pumping this out, keep their workers employed. There's over 15,000 people just in the ISR sector in Kazakhstan, and they had this depreciating currency, and they're getting US dollars in. So it worked for them. So they didn't have to decrease production. You're going to see the same thing in the ag sector with the Russians and in Belarus. Same thing. They're just starting to modernize, and they're able to produce in a weaker currency. So there's major implications across the commodity sector. And last time I checked, if you look at the major growth of copper mines and gold mines, they're not in the US. So major implication for resource stocks. Uranium, I think this is a great place to be, but I've been there and done it, traveling around the world, putting body armor, thinking, hey, if Robert Friedland went to the Congo, maybe I'll make a big score going to Kosovo, and I did all sorts of crazy shit when I was younger. I have zero interest in doing that because the sector's so cheap. The way I'm playing it is I'm one of the largest shareholders in Uranium Royalty Corp, and I'm just going to pick off these royalties. So Rob McEwen earlier said, you know, it's a bad, these royalty companies are, you know, like pirates. Yeah, pirates kick ass, and they're going to make a lot of money in the sector. So another thing, you may disagree with me on this, because 2 years ago I was invited to give a big talk at this, it's called the SIC, and I said, look, green energy is economic, and it makes money even without government subsidies, and it does, but mining people, for whatever reason, don't want to believe that because they want to believe you need coal and you need oil. No. Green energy is real, it's economic, and it's really going to kick ass when they have utility scale green energy storage. Vanadium is the absolute key, the vanadium redox battery, and I'm actually here, I spend a lot of time on the road. I think the only other guy who's on the conference circuit more than me is Frank Holmes. And I'm here because what Paul Matisek and Colin are doing, I've put up every financing that they've given me my allocation, I take it. Nevada's the Saudi Arabia of vanadium. And I've been to the Middle East, I've been to Iraq, I've gone through Kuwait and Saudi Arabia. I haven't been to Iran. You don't want to go to those places to produce. And here's the other thing, they don't want you either, and they don't need you anymore. So the whole paradigm shift of 15 years ago is, I can go to Kazakhstan and build a mine. We don't have an edge over the Russian or Chinese or other Asian money. I can go to Nevada. The metallurgy is the key for most of the projects. That's what's going to break most of these projects. I believe Paul and his team have solved that. Victory Metals is one that I think I'm one of the largest shareholders. I think I'm top 10. And I'm talking my book, but I'm willing to go public and say it's the right people, it's the right asset, and the right structure. So if a short attack comes on it, most management teams bitch and complain and don't have any money to put up. Let's see what happens if somebody tries to short this. And I love my fund KCR. The reason why I came up with the name Casey was it's out of respect for Doug Casey, but the K is me, Katusa. C was Doug Casey, and the R was Rick Rule. And it was the only thing that Rick's ever done out of his own franchise. And the thesis was Lucas Lundin is expensive, Ross Beatty is expensive, Robert Friedland is expensive, because everyone knows who they are and they carry a premium. So the concept of the KCR fund was, let's put a bunch of money in and let me go find the next Ross Beatty. Let me go find the next rock star that people don't know. And I think, and I'm putting a lot of pressure on him, is Colin really has the chops. And it comes back to where he grew up in the sector. I first met Colin when his father, I was at a table with his father and Doug Casey and Amir Nani, who I also believe is a major player and I'm a big financier of. We're going to do a deal in the uranium sector, and I can't remember if it was 05 or 06, and Colin, I don't think you mind me sharing the story, but his dad had $75 million on the table. And everyone on his team, and granted, everyone in the sector at the time thought it was going higher, and I think within 5 years, Amir bought that project for a couple of $1 million or something. And I think Colin experienced that, and it's in his DNA now, that what is the one thing that separates a Ross Beatty, a Lucas Lundin, and a Robert Friedland from all the other guys who had $75 million on the table or $750 million on the table and didn't? Selling. That's the absolute key. All of them have put great people around them. So when you look at, I've known Paul Matisek for over 15 years. Very few people have sold as many projects as him. And I'm telling you, like, he is the king of the niche market. So if you don't know the story, go talk to Paul. And I think he's grooming Colin for the next deal even after this. And that's why I'm there, because if I don't get a phone call for the next one, he's going to have to deal with the Balkan revenge. So the IoT, the Internet of Things, will reduce energy consumption. For example, yesterday we were all at the wharf, right? Nighttime, it was really windy, and yet all the fans were blowing, right? You guys notice that? So in 5 years, Honeywell and all the guys who make those, that's not going to happen anymore. They're going to have sensors, and when the wind's blowing, it's going to shut off. The HVAC system in these buildings, it's going to know ahead of time how to properly push the air out with what temperature is out. The lighting, everything's going to be run much more efficient. For example, your dishwasher. If you load your dishwasher, everybody wants 99% of people, when you load your dishwasher, you put your stuff on, you turn it on, you walk away, right? The next, they're already starting, you do that, the dishwasher will start when it's the lowest cost of electricity. Your electricity is not constant. It varies throughout the time. Same's going to happen for electric vehicles. When you plug it in, it's going to know when to recharge your battery. And It'll even know when to discharge that from your car to light up your security lighting around your home and all these things. So the interesting part of this is residential appliances will result in lower energy costs for everyone. Even at the mines, we're starting to see amazing Internet of Things that are reducing costs. The grid will be much better utilized. So this whole fallacy that we're going to need more, I think you're going to end up seeing that we're going to need less. And innovation will solve most bottlenecks. For example, metallurgy. The breakthroughs we're seeing in metallurgy right now, I don't need to go to Russia for vanadium. It's in Nevada. Fracking 2.0. I debated my partner on this. He thought I was crazy just a few years ago when I said on one pad you'll be able to do 64 fracks. Now we're seeing 250 fracks in a single well. Now you're seeing it with the cube drilling. What used to take one well complete, you can do 16 wells from the same pad. The innovation in the cost of production in North America is incredible, and it's only going to get better. We are not running out of oil. We are not running out of natural gas. We are not running out of commodities. What we are running out of are regions where entrepreneurial capital is being respected for trying to exploit those resources. So that's what you have to be. What we're running, there is no peak gold. Ian Telfer wrote a blurb on the back of my book. He's a good friend. He's the chairman of Goldcorp. I'm sure Rob McEwen and him have some amazing stories to tell you on their admiration for one another. But he's big on peak gold. I don't buy it at all. There's peak government stupidity because they keep taking more and more, and then what's the point? I'm not a libertarian, but at a certain point, don't go where your money's not respected. You're going to continue higher government takes, higher social costs, because you got to make everybody happy, which, you know, ain't ever going to happen. And the higher environmental costs for energy and resource extraction, for example, going from stacked tailings from regular tailings, you're adding about 5% on your costs. So these are all things that are going to be changing.
Think you understand the junior mining sector, and you think that the participants in the mining sector, junior mining sector, are good people and kind people, hit the bid.
How violent that term could be, it actually could be quite violent. It could be a rip your face off uranium rally.
And the world is always going to need raw materials. It's going to need copper and gold and nickel and so forth.
Totally destabilized. Hey, Troll, did you hear what's going on in Yemen?